Good morning, good morning, good morning. It is finally Friday. It looks like we made it. Friday, the 6th of February. This is the Morning Blast with myself, Ryan, and of course, Michael. Usual caveats apply. Beware of swear words, etc., and expletives. This isn't for the faint-hearted. Do not complain if you get offended. Nothing we say is trading or investment advice, etc., etc., etc. Michael, how are you?
Well, very good morning to you, Ryan. Good morning, everyone. A very happy Friday. Very much looking forward to a beverage or three with you later on, the first of which will probably be a hair of the dog. But it's been another tumultuous 24 hours or so since we last spoke.
Do I detect you're a little bit hungover?
Yeah, a little bit.
Good.
I'm surprised you're not.
I am. No, I really am.
You're just trying to cover it up.
I'm just wearing it incredibly well.
Oh,
No, I also had a couple of cigars last night, which are now I'm tasting them as well. Which
oh dear.
it was a lovely Irish edition punch cigar from the cigar event at JJ Fox last night. Yeah.
Oh, very nice. I must say, though, actually, having said that, my sort of anecdotal economic evidence from last night is that pubs in the City of London did not appear overly busy for a Thursday night, which is slightly concerning. They must have all known you were out.
Well, quite. And also, I'm not saying it's the same anymore, but it used to be on a red day, you would see far more people in the pub. But obviously,
well, this is it, right? So, I was expecting it to be absolutely rammed. There's hardly anyone around.
Oh, well, there you go. So everything is changing. There you go. Right, so we crack on.
Well, we may as well, because as Clive's rightly said, you are doing better than last Friday because you've actually turned up today. So we might as well make the most of it.
Quite. Well, speaking of Clive, let's give an update from the big man himself. He's got a very busy day today. He's got an exciting day today. Although not joining us, but no, swiftly moving on before I get absolutely buried by him. Do send Clive some messages of encouragement. Anyways,
needs to keep his strength up, doesn't it?
Speaking Guinness, it gives you strength. Speaking of Clive and market moves, etc., levels to watch. Obviously, it was risk off vibe yesterday. S&P 500 dip buyers didn't turn up, and weakness was seen back to the 67.85 level. Then 67.52 overnight, where we've seen the opposite trade, where some buyers have stepped in. 67.36 is a Fibonacci level to watch of note below. Eurostoxx 50 futures, they dipped to 58.65 in Asian trade. Don't do the eyes. 58.53 is support of note below that. FTSE Bull, I give up. FTSE Bulls has done well lately relative to its peers, but posted a powerful bearish engulfing line yesterday. Bund futures, they rallied.
Blame Rachel.
Bund futures, they rallied to 128.58 this morning, where we failed in the at mid-January. So the bulls would do well to see that level off and close above. T-notes posted a big slab of green yesterday, 112.06.5 and 111.31 are now the supports to watch on any dips. Cable saw a big sell-off on the tight BO Bank of England decision, down to 135.17. More from Michael on that in a second. Bitcoin, a proper shoeing through that 74,000 and 70,000 level. We suggested, we've been talking about for the last God knows how many weeks now it feels like. 58,000 is a level on the downside to watch. That's the next downside just yesterday. 60,000 is low today, so definitely keep an eye on that. And for those that really want to get nervous, 34,500 is a deeper target for Clive, much lower down. So the story of the week is obviously metals. Gold actually held up pretty well yesterday, maybe part of the risk-off trade. Silver, however, in its own world right now, and it's a volatile world, we've seen dips down to 630, fucking hell, 63.90 so far today, and then a rally to 75. Gone.
I was going to say, just on silver, you mentioned Bitcoin as well. I was looking at some vols earlier on. 1 month, because, that's what you do on a Friday morning. 1 month implied vol of silver is about 86%. 1 month implied of Bitcoin is at 74%. So the market's perception is that silver over the next month will be choppier than Bitcoin, which kind of speaks volumes about this.
Yeah, it's all getting a bit crazy. Actually, I'll quick word on Bitcoin in a second, but one sec. So where was I? Most other metals have set a weaker tone in recent sessions, but still have chances to stage a recovery. Key supports holding in markets like LME, copper, and zinc. Brent crude oil continues to hold its Marabuzu support at 66.94. Yesterday's low was 89. So that should cheer the bulls and see us return to recent highs at 70.58. I do hope so, Clive. TTF, Dutch Gas, posted another doji yesterday, which, as you know, small body, long wick, big like myself. This was one with lots of upper shadow as we got to key resistance at 35.17, where it found some sellers. Quick note on Bitcoin.
Go on.
I'm not saying it's all over, but it's not looking good out there, is it?
No, it's not at all. I mean, I'm no expert, but I can tell you that it looks pretty fucking ugly.
Obviously, I'm looking to people like Cam and our good friends Cam, etc., who are kind of crypto specialists. But we're kind of how many years in? There's still no real utility case for crypto because it's not a replacement for the dollar. It's basically just a leveraged risk play. And I was thinking about this yesterday before I got too many beers inside me. But potentially one of the worst things that's happened to crypto, well, Bitcoin and Ethereum and stuff, is the launch of stable coins. Because we were kind of sold the idea that Bitcoin, etc., was a way, to move cash around, etc., etc. But obviously the volatility in it means it's, not exactly practical to use Bitcoin to transfer wealth, when whilst you're transferring, it might shed 10%. And that's where kind of stable coins have stepped in, and they are genuinely a very good way to transfer wealth around and transfer funds around. And why would you use Bitcoin to do that when you can use stable coins? There you go.
Yeah, no, I mean, I think you might be onto something there. I was going to say, and also just sort of sentiment around crypto seems utterly dire. I was going through some of our crypto channels internally this morning, and it just seems, well, firstly, a sea of red, and also, any case for upside is kind of just hope that it might bounce as opposed to something fundamental. So, I mean, I don't profess to be an expert on, well, anything these days, but certainly not Bitcoin. So, take that with a pinch of salt. But yeah, it looks a bit dicey to say the least.
I've got to say though, and I apologise for the Bitcoin maxis, etc., that are out there, but I think I speak for a lot of people when I say that I'm just waiting for MicroStrategy to implode and collapse, because I think it'll be fucking hilarious.
It will be objectively funny when that happens. We're probably not too far off it, to be honest. There we go.
Objectively hilarious. But anyway, Michael, what happened yesterday?
Yeah, indeed. As for yesterday, then, of course, Clive has run through all of the market moves. It was a pretty risk-off day across the board, and really that fall that we saw, that precipitous decline that we saw in Bitcoin, speaking volumes about that. In terms of fundamental developments, we did have, of course, two G10 policy decisions, the first of which on Threadneedle Street, with the Bank of England holding bank rates steady at 3.75% as expected. That said, it was a much tighter than expected vote split, which is bloody annoying because I didn't have the bollocks to keep my call that it was going to be 5-4. Indeed, it was a 5-4 vote. Only Governor Bailey switching his vote from December to join the camp to hold rates steady. Having said that, though, you also had a dovish tweak to the forward guidance, with the statement now explicitly noting that bank rate is likely to be reduced further, providing that the inflation outlook continues to evolve favourably, and also a dovish set of economic forecasts as well. The Bank of England now expecting that inflation will be at or around the 2% target in April, and more importantly, that it will then stay at that level over the next 3 years of that forecast horizon. So all pretty dovish from the BOE, and we have seen a considerable repricing of market-based rate expectations. We now have around a 70% chance of a rate cut in terms of the swaps curve at the March meeting, and that next 25 basis point cut is fully priced by April, with two 25 basis point cuts discounted by the end of the year. As we said, This time yesterday, the BOE was very much a case of laying the groundwork, setting up the foundations to deliver a rate cut at the next meeting. And indeed, if inflation does continue to behave itself between now and mid-March, then a rate cut in March is pretty much a done deal. As for the other policy decision yesterday from the ECB, really kind of nothing to see there, to be completely honest with you. They kept all policy settings unchanged, maintaining the deposit rate at 2%, while reiterating that they will continue to take a meeting and data-dependent approach to future policy decisions. Once again, ECB President Lagarde noting that they are still in a good place and that they are not pre-committing to a particular rate path. The ECB are pretty much done and dusted at this point. The only potential area of interest in that meeting was going to be any comments around the euro, and Lagarde basically shrugged that off, saying, yes, FX is important, but the euro has been rallying since last March, and the impact of that euro strength is already accounted for in their baseline scenario. So really not too much concern about where the euro trades.
That is kind of what we said in yesterday's show, like as in a preview for the ECB, was that they're going to look through euro strength. So that was nice to see that we kind of called that correctly.
Indeed. Something else we called correctly was the downside surprise that we had in the, upside surprise, I should say, that we had in the US jobless claims numbers, with initial claims coming in at 231,000 in the week to the 31st of Jan, up for a prior 209. Again, this is likely weather related, the US having a really bad cold snap over the last couple of weeks. If you're in sectors such as construction or tourism, you're clearly not going to be able to work, or not work as much as you might otherwise, and you're going to be signing on for unemployment insurance. So I wouldn't be too worried about that uptick that we saw in initial claims. However, one thing that is a little bit more concerning is the job openings data that we had for December. JOLTS job openings coming in at just a touch over 6.5 million in December, well below the consensus and the prior of around 7.2 million. And again, just pointing to how the US labour market is under the surface potentially not as robust or as resilient as the FOMC may want it to be, or as the unemployment rate, which is just flat at 4.4%, may imply. So certainly one to watch there ahead of the jobs report, which we'll be getting on Wednesday next week. Of course, that was postponed from today due to that partial government shutdown. In terms of other bits and bobs, just a few lines of corporate news worth mentioning. We did have earnings from Amazon after the closing bell yesterday. Apparently, I was too many beers in to notice at that point. The figures themselves were actually relatively solid. EPS just a touch below expectations at $1.95. Revenue beating expectations at $213 billion. AWS sales were pretty strong as well. Again, though, and in line with what we saw with Alphabet on Wednesday, it was really the CapEx guidance that markets took a pretty dim view of. Amazon guiding to $200 billion worth of capital expenditure in the fiscal year 2026, well above expectations of $146 billion. Amazon were down as much as 10% after hours on the back of that CapEx guidance yesterday, obviously dragging the NASDAQ and the S&P future lower with it. In terms of other corporate news in the mining space, Rio Tinto and Glencore, apparently they have called off their potential merger for a second time. Of course, they were first talking about this last year, gave up, started talking again. Now they've given up again, according to Bloomberg sources. This is because Rio Tinto was apparently unable to reach an agreement that would deliver shareholder value. So that looks to be off the cards for the time being. And lastly, for the time being at least, Novo Nordisk, they have had an absolutely terrible week. Probably the only people who've had a worse week than them are people who've been trying to long silver, given what's been going on. They issued terrible sales guidance on Wednesday, as they were expecting sales to potentially fall as much as 20% this year. Yesterday, a company called Hims and Hers have basically launched a knockoff version of Wegovy, which is priced at about a quarter of the price that Novo Nordisk are charging. So after Novo shares were down 20% on the back of that sales guidance, they then fell another 10% yesterday after people have started trying to copy their main product. So really not going well there. The other thing to remember with Novo Nordisk, as we've mentioned numerous times before, they make up a frankly humongous amount of Danish GDP. So I would just caution that you could potentially see some skew in Danish economic data, if that's something you pay attention to.
Very niche, but there you go.
Very fucking niche, even for me. But do just bear that in mind, that you could see that have an impact at a slightly broader level. But that's all from me, time being.
Well, thank you very much. Well, that kind of takes us nicely to our topic du jour, which is the generic kind of risk-off trade that we've seen this week. And what the fuck is going on in markets? Do you just close your eyes and buy the dip, but it keeps on dipping at the moment? Um, you know, but jokes aside, like one thing we do say a lot, again, is never trading or investment advice. We keep telling you that, but one thing we are very passionate about, if that's the right word, is kind of capital preservation and kind of trying to extol the virtues of, sometimes it's not about making money, it's keeping money, and I think that's definitely the period that we're in at the moment. Yeah, let's be honest as well, though, and this is one thing that kind of grates me, and I did put out like a little meme about it a couple of days ago. Yes, the markets are in a bit of a pickle. Yes, it hurts. But if you're sitting there having sleepless nights because the S&P is off a few percent, you've got too much size on, basically. And I think this is the kind of period when people that have been kind of maybe a bit lax on the risk management side and kind of like the capital allocation side, maybe being a bit too balls to the wall. Because obviously everyone's a winner, everyone's a great trader when it goes up. But this is the period that sorts people out when, we kind of work out, how good you really are is if you can survive these periods. I don't know what you think in terms of this, in terms of from a trader's aspect.
No, I think you're absolutely right. I think it speaks volumes about, and again, obviously not investment advice because I have to say that. But yeah, I think it speaks volumes around risk management and also the position sizing, the degree of leverage that you're taking on. Where, I was just pulling up some charts to prepare for this segment. The S&P is, as near as makes no difference, 200 points off a record high. And actually, if you zoom out, the S&P has been in a 400-point range since last October. And we are literally slap bang in the middle of that range.
Yeah.
6,600 to 7,000, and we're trading at 68 this morning. If a move of that relatively small magnitude is causing you significant issues, then I think your strategy probably does need some considerable work.
Exactly.
Because, yes, it hasn't been a particularly fun week. I don't think anyone will be claiming that. And certainly if you've got a portfolio that leans heavily into the tech sector, it's going to have been an even worse week. However, in the grand scheme of things, we are not talking about a market, well, obviously metals are, but we're not talking about an equity market that is melting down. We're not talking about an equity market that is falling off a cliff. The S&P is down in a drawdown of 3%. The Nasdaq's in a drawdown of 6%, for goodness sake.
Well, so you got the charts in front of you. What's the S&P on the year so far?
Hang on. I think we might be about flat.
Yeah, right. So we're about flat on the year. Are literally just touching or just tickling all-time highs. Like, people losing their mind saying, "Oh my God, stocks it's over for stocks." Other word, it is like, we're very passionate. We love a cliche on this show, but it's very much if in doubt, zoom out. And to say the world is falling is absolute bollocks.
And I think the other thing to consider is, sit here now, zoom out, look at the charts for data, whatever you want to do, but also reflect on, compare now to say a week ago or 2 weeks ago or 3 weeks ago. All of those factors that everyone, and myself included, was listing out, 2 or 3 weeks in terms of the equity market. You think about things like, well, that's still there. We've had really solid manufacturing and services data from the ISM in the United States this week. We've even got PMIs here in Europe, surprising to the upside as well. You then think about things like earnings growth. Well, we're set for blended earnings growth of about 11% in the fourth quarter of last year. That would be the fifth straight quarter of double-digit earnings growth. That's still very, very solid. You think about the fiscal backdrop. One of the things we've all been talking about is how there's going to be a positive impulse from the fiscal side of things in the States this year. That's going to come from the One Big Beautiful Bill Act. It's not as if they've suddenly repealed that. That is still on its way. We're talking about a looser monetary backdrop. Again, that is still on its way. The Fed will be cutting rates once, twice, if not more, later this year. They are going to get that Fed funds rate back towards a more neutral level. So again, it's very easy to kind of get swept up in the hysteria and the hyperbole of the intraday volatility, particularly when you've got, one of the things I've noticed over the last day or so is headlines have moved from the S&P is down 0.5% to tech stocks wipe out X billion dollars of market cap, which is about one of those stupid ways to measure anything ever.
And that's the point.
Step back from that nonsense.
Well, this is the thing, and you raise a great point there, and I think this is the thing. It is literally just the tech sector at the moment. There is that, we mentioned yesterday about how you got to be, look under the hood sometimes, and this is, tech sector led. We know this. It's very obvious that this is what's bringing the market down, which is why the equal weighted S&P is outperforming. But what that does also mean is there is strength everywhere else in the market. Remember, like, you know what it's like, Michael, where people talk about the bad breadth of the markets and people get all panicking. Well, breadth at the moment's really good, but stocks are still
Yeah.
suffering because
Yeah, it's funny how people who were complaining
very
about
quiet.
bad breadths are now complaining about something else,
Yeah,
presumably.
they're all very quiet. Yeah, most stocks now are doing all right, but it's just the tech, like, the large weighted stocks. Yes, Clive is telling us and reminding us the Dow looks fine, which is, but as much as we hate the Dow, but that's because it hasn't got the tech names in there, and also it's price weighted. But what that does tell me is that all we need is for tech to find like a local bottom, and find a bid, and the market's going to be screaming higher straight away. So I'm not.
Yeah, and I mean,
And the thing is, just
oh, go on.
before we go back and then back to you, and then what we got to look forward to for stay in the weekend, yeah, it's not trading or investment advice, but try and give me an argument why I shouldn't be closing my eyes and buying the dip.
Well, I'm certainly not going to do that because I don't think I can. Just a couple more points on that. I think there's, again, context is key. The S&P, as I said, it's been sort of consolidating over the last few weeks. We are still up 50% from the lows that we printed in the aftermath of Liberation Day. So, again, not disastrous by any stretch of the imagination. And yeah, it's absolutely a tech-led decline that we've seen, and perhaps more accurately, a software-led decline that we've seen. The question is, really, do you go, okay, well, the rest of the market is going to also roll over and sort of catch down to the tech sector? Or do you play the opposite side of that and say, actually, some of this weakness could well be overdone, and actually the tech sector will bounce and all will be sort of right with the world once again? And, I would certainly lean firmly into that latter scenario at this point.
Definitely. Well, Michael, what have we got to look forward to today?
Yes, indeed. Well, quite. I'll start with something we haven't got to look forward to today, which is the January US jobs report. As I mentioned, that has been delayed. That will be released next Wednesday, the 11th of February. So anyone who's holding out for NFP today, sorry to disappoint you. We do get employment data from Canada this afternoon, though. The Canadian economy set to have added 5,000 jobs in January, with unemployment holding steady at 6.8%. Money markets price around about a 40% chance that the Bank of Canada will deliver a 25 basis point hike by the end of the year. So potentially one to watch there. The only other notable data released today comes at 3:00 this afternoon. I will not be on the desk for that, which is the consumer sentiment figures from the University of Michigan. That index expected to fall marginally to 55 in February, down from the prior 56.4. Besides that, we do have a few central bank speakers worth bearing in mind. The Fed Vice Chair Jefferson will be speaking this evening. BOE Chief Economist Hugh Pill, who of course voted for rates to remain unchanged, he will be speaking this lunchtime. And we also have the usual round of ECB speakers who will come out and throw their two penneth worth in the aftermath of policy meeting.
Sorry. Two penneth. God.
Yeah.
Why are you so Victorian?
Well, I got slagged off for saying top and bottom of the hour the other day, for goodness sake. I can't say anything on this programme anymore. We have already heard from 6 ECB policymakers, and it's not even 9:00, so there's going to be a fair few more on that front. Besides that, do just bear in mind a couple of things to watch over the weekend. The first is obviously the geopolitical situation. These talks between the US and Iran are taking place in Oman today. Not entirely clear how long they'll go for, whether they'll run into the weekend, what they're hoping to achieve, but it is certainly an environment where participants will monitor the progress of those talks very, very closely. It's probably another one where no one really wants to be short crude over the weekend either, given the potential for gapping risk if we do see tensions escalate once again. And speaking of gapping risk, anyone with exposures to Japan, either the yen or JGBs, of course, recall that Japan is having its lower house election on Sunday. Expectations are that the LDP will win a majority in the lower house, which will sort of cement Prime Minister Takaichi's position. Do bear in mind, of course, that dollar yen has been kind of grinding higher over the last week or so. We're trading 157 now. The lows were about 152 a few weeks ago on the back of all of those rate checks. So I wouldn't be at all surprised if we were to see a further bout of yen weakness. Then obviously we're going to start being on watch for intervention and jawboning and potential rate checks to be taking place once more. So just something to keep on the radar as we move into next week. But I think that is all from me this morning.
Wonderful. Well, Michael, thank you for another outstanding week. Listeners, thank you so much for tuning in. A couple of bits, like we said before, anyone that's in London and fancies a beer later on, we will be in the Cross Keys for non-farm pints. PIQ and Trader Flow. We've got a trading competition that starts on Monday, so get involved with that.
Don't try and trade soybean meal.
Don't try and trade soybean meal, unlike our dear friend Tom that was getting irate that he couldn't get a position on. But yeah, so check out piqsuite.com along the top banner thing for more information on that. Do get involved in that. Some decent prizes. Yeah, whatever you're doing, keep it tight, stay safe, stay out of trouble. Remember